What are ETFs? Exchange-traded funds are investment products that replicate the returns of a particular index. They have, in contrast to other index products, very low tracking errors, which means they have a small deviation from the index. ETFs are daily traded assets on exchange markets, similar to normal stocks, while mutual funds are usually traded by their investment company. It is a passive managed product where the fund manager doesn't engage in stock picking. That means not picking individual stocks. Mostly those are traded autonomously by computer systems. The structure of an ETF can be generally built in two different ways. The build of the ETF determines how the target index is tracked and what assets the index can hold. This impacts total cost, projected returns, and anticipated risk. The first one of those two builds are physical ETFs. A physical ETF tracks the target index by buying and holding all or some of the underlying assets of the index. For example, an ETF that tracks the S&P 500 index will consist of either all 500 companies in the S&P 500 index or a representative sample of that basket of stocks. That's how the index is exactly replicated. The second way to replicate an index is with synthetic or swap-based ETFs. A synthetic ETF does not invest in assets directly, but is ideal for exposure to hard-to-access assets like commodities such as crude oil. But this way is a bit more complicated and will be described in another video, and because most ETFs available on the market are physical. There are also two different types of ETFs. ETFs cannot just replicate indices for stocks, but also, for example, currencies or commodities. Two special types of ETFs are short and leveraged ETFs. An inverse ETF is set up so that its price rises when the price of its target asset falls and vice versa. The ETF is designed to rise as the index falls in value. For example, an inverse ETF can be based on the S&P 500 market index, meaning that when the S&P 500 drops by 3%, your ETF rises by 3% and vice versa. Leveraged ETFs are unique exchange-traded funds that use debt to increase equity positions. They have greater risk and return attributes compared to other types of ETFs. Which means when we use a S&P 500 ETF with a leverage of 10 on the index and the index rises by 3%, our ETF rises by 30%. But when the index drops by 3%, our ETF drops by 30%. So what are the advantages from an ETF? The biggest advantage from an ETF is the diversification of your investment in different assets, industries or countries, which is minimizing your investment risk. The physical structure of an ETF has the advantage that it doesn't have an issue risk, which means when you, for example, invest in an ETF published by a company and the company goes bankrupt, the ETF still keeps its value. And ETFs are significantly cheaper than mutual funds, because they are managed passively and so there are no costs for active fund managers. The fund manager for ETFs just need to replicate an index once and must implement changes if necessary, if, for example, the index changes itself. If you are interested in other financial topics, consider subscribing to this channel for weekly videos about investment, finance and economics.